Okay, let's look for more trends. So check out the share count and what patterns do you see in the past 5 or 6 years? Take a close look. The pattern you see is that there are fewer shares. There's actually about 100 million fewer shares every year in the past couple of years. And that's because Microsoft has started to use its massive cash balance to buy back shares. I'm not going to add back the cash balance when I model this company because I'm assuming and I'm bearish on Microsoft, unfortunately. I'm assuming that they're going to use that massive cash balance to buy back shares over time. Okay. And so what happened with Microsoft is they kind of transitioned from a growth stock into a value stock, and the stock really didn't really move much in 10 years. Okay, it didn't really move very much because it was in no man's land, right? It was a growth stock for the 80s and 90s. It was a Wall Street darling. Okay, growth investors loved it. It was my biggest position in my portfolio in the 90s. I loved the company, loved it for years. And then what happened was once the founder left, Bill Gates, when he left to become chief software architect in 2000, and eventually he transitioned out of the company to run the Bill and Melinda Gates Foundation, which is awesome. But when he left, the company became a big bureaucratic nightmare. And Steve Ballmer probably wasn't the best choice to be CEO, but it wasn't Ballmer's fault. He's just not the founder. And don't ever invest in a technology company when the founders have all gone. And in the leftover section of this course, chapter 15, class 15, I'll talk about this in a lot more detail. Okay, great. So look what happened. It looks like they're buying back a lot of shares. That's a pattern. Pattern recognition is important when you're modeling. Okay, all right, good. Now, we've analyzed all the patterns. Let's now forecast revenue. Okay, so what we do is we just forecast 1 year after the next. And again, we're not going to look at each subcomponent of revenue. We just don't have time. Okay, great. So you're going to add assumptions like comments, why you're assuming certain numbers. Okay, so in 2016, I'm assuming in this hypothetical example, okay, that Windows 10 revenue is going to kick in. Okay, and that's why you see revenue growth spiking. So Windows 10 is free for the first year for most consumers, right? And then people have to pay for it in the next year, right? And that's why I'm assuming that revenue growth is accelerating a bit in the out year, right? So it's not an exact science, but I just want to prove a point here that just add comments to your model. Okay, great. And I'm also assuming that you're going to have higher gross margins next year because Xbox One, which is the latest version of their Xbox console, Xbox One sales are slowing. Okay, and that's a good thing for investors. Why? Because hardware is less profitable than software. Okay, you have to have factories to make that stuff. Right, it's less profitable. Okay, great. So I'm also assuming that the cost of revenue metrics are going to improve because the new CEO, Satya Nadella, who's the right choice, by the way, he created the cloud division at Microsoft. He created an amazing product they have called Azure, which is a cloud computing product. And so he's got cloud in his DNA. And the reason the board of directors selected him to be the next CEO after Steve Ballmer is because he understands the cloud. And cloud computing is much more profitable too. So anyway, we're going to assume that he's probably going to spend a lot of money in R&D in that area too. Okay, cool. So just add your comments. Add your comments, okay? And then what we're going to do is using pattern recognition. Remember, the number of shares goes down by $100 million each year. I'm going to assume that's the case going forward as well. And there you go. We are done with the model. We're done with the model. That was easy. Great. Well, hold on a second. I still have questions on how to build the model. Okay, here's what you do. Go back and read the 10K. Look at the investor relations website and listen to the saved earnings calls that they have on the investor relations website. So every 3 months, a company has to report earnings. And they hold this earnings call, which is about 45 minutes. The first 30 minutes, investor relations and the management team read a canned statement. We have another great quarter, even if they didn't. We had another great quarter, blah, blah, blah. And then the last 15 minutes of that call is the Wall Street analysts get to ask questions. And they ask pretty good questions too, actually. Okay, hold on a second. I did all that stuff, Chris, and I still have questions. Okay? All right. This is why the investor relation function exists in the first place. We can ask them the questions that we just can't answer. Okay? Give them a call. Just ask, like Steve Jobs does. It's their job to help you, okay? And again, why do we call management only at the end of your due diligence process after all your research is done? Because they're the best darn salespeople in the world. That's how they got to that position. So be careful, okay? Do your own research first. Don't listen to them. Don't listen to the media. Do your own research first, right? Okay, and remember, everybody's got their own bias, right? Everyone's got their own bias. So whenever they interview a CEO on television, of course she or he is going to only say very positive stuff. It's their job, right? And when fund managers or portfolio managers are being interviewed on television and they're asked what stocks they like, of course they're going to talk about stocks that they own. They're talking their book. They're biased, okay? So just do your own research and don't give in to the bias. You'll be a better investor because of it in the long run. And remember, you've got the exact same access to information that Wall Street analysts have. It's called Reg FD, and it's a beautiful thing. Reg FD stands for Regulation Fair Disclosure. And after 2001, when a lot of people lost a lot of money investing in the markets, the government created this. And they created this so that you and me, the average investors, can get access to the exact same information at the exact same time as the big mutual funds like Fidelity or Capital or all these other great companies do, right? And if companies don't give you or me access at the exact same time, meaning publish it on the website or hold webcasts, then they get into big trouble. But yes, you see, I'm not going there. Okay, so modeling and valuation is very, very easy to do, and it's a lot of fun too. Okay, next topic, valuation. Okay, so we've created our forecast for Microsoft, okay? We've got our earnings per share, okay? We've listed all of our assumptions. You can put in little comments, those red little Post-it note things within the spreadsheet, or you can create a column like I did here in column AH and list assumptions there as well. All right, now let's look at ways to come up with our target price, okay? And I'm going to give you a couple different methodologies, and you choose what one you like. But I recommend using a couple methodologies and then taking the average of 2 or 3 of them. The reason is because you want to normalize the error you might have made in 1 or 2 methodologies, okay? So use whatever methodology you want to, but I want to expose you to a menu of other ways to do it, okay? So I'm going to show you 3 methodologies, and I'm going to take the average price of all 3 for my target price, okay? Remember, keep it simple. Less is more. The more complexity you add to a model, the more chance you have of getting the wrong results. Okay, less is more. Keep it simple. Okay, valuation methodology number 1, and this one is my favorite. Why? Because it's simplistic. Price to earnings ratio. Okay, so your target price should be based on estimates 5 years from now. Okay, 5 years from now. Remember that I've said that before many times. 5 years from now, is this company going to be more relevant or less relevant than it is today? Okay, so look at your estimates 5 years from now, and I promise you, your estimates are going to be way off what everyone else has if you do your own research. If you fall into and become a victim of groupthink and you listen to other analysts or smart people on TV or perceived smart people on TV, then you'll just think in line with them. What's the point? Okay, so in 5 years from now, earnings, according to our model we created, 5 years from now, earnings are going to be growing at 12%, okay? So our target price in 5 years should be 12 times that EPS number or that earnings per share number. Wow, that was easy. That was easy, okay? So 5 years, and I'll explain why in a second. Bear with me, please. So 5 years from now in 2020, we're expecting earnings to be $4.90. And so that $4.90 in 2020, you've got growth there of 12% year over year. And so we're going to choose to value our company in 5 years on 12 times that number. Why? Well, here's why. The stock market tends to trade in line with their earnings growth rate approximately over time. So if the market has earnings growing for the average company at 15%, then the market usually trades at 15 times earnings, okay? If the economy is on fire and doing really well, then companies might grow at, say, 18 or 19% on average earnings. And so that means that the market should trade at 18 or 19 times earnings. And companies that are growing more slowly than that will trade at their earnings growth rate. So if a company's only growing at 9% earnings per year, then that company will trade at 9 times earnings. Okay, it's a good proxy. It's close enough. Okay, close enough. So let's say the market trades at 15 times earnings on average, historically speaking. It's because the market is growing at 15% earnings. And so again, if you have a company that's growing at 25% earnings, usually, in most cases, that company will trade at 25 times earnings. And again, if a company is growing at 8% earnings, usually that company will trade at 8 times earnings. Okay, it makes sense, right? So Microsoft, in 5 years, according to our model, will be growing at 12%. Okay, so what does that mean? That means Microsoft should be trading at 12 times our $4.90 estimate in 5 years. Okay, remember, we're assuming we're at the beginning of 2015 for this exercise. So what does that mean? That means a target price of $59. Okay, and Microsoft, when I created these slides, okay, don't look at what the price is at now. I have no idea. Microsoft was at $47. So that means that Microsoft in 5 years is going to appreciate 25% to a value of $59 per share, right? And that sounds logical because over 5 years, that's about 5% per year, right? And you expect a slower growth large company like this to grow slowly over time because earnings are growing at a slower rate than the average stock out there, okay? Great. So it seems reasonable for a mature company. Okay, let's move on to valuation methodology number 2. Remember, we look at a couple of different ways to value a company, so we can take an average of all 3, just in case we're way off on one of those valuation methodologies. Pick your poison. Do whatever methodology you want, but I'm going to expose you to 3 ways. So we look at price to revenue for valuation methodology number 2, or price to sales. Remember, sales and revenue are the same thing, okay? And so let's assume, just for this hypothetical example, that the average software company is going to trade at 5 times revenue in 5 years, okay? 5 times revenue, the average software company, okay? And Microsoft is a big mature company, and so it's going to grow at a much slower rate than the average software company, right? Let's just say it's growing at 70% of the rate of the average software company. So instead of trading at 5 times revenue, in 5 years, Microsoft will trade at 3.5 times revenue. Okay, makes sense. 3.5 over 5 is 70%. Okay, so the market cap should be $504 billion in 5 years. How do we get that number? Well, we basically took 3.5 times our revenue estimate in 5 years. Okay, that gets us to a market capitalization, or the value of the company, at $504 billion in 5 years. Microsoft's a big company, man. Wow. All right, so the market cap is $372 billion today. So that means you get about 35% upside, okay? So, here's the math on it. So in 2020, we assumed that there'd be about $144 billion in revenue. Microsoft's massive. And then we multiplied that by 3.5 times. Why 3.5 times? Because the average software company in 5 years, we're assuming, is going to trade at 5 times revenue, and Microsoft is growing at 70% of the average company, so 3.5 times. Okay, capiche? Makes sense? Good. Okay, great. So remember, valuation methodology number 1, which was price to earnings, which is my favorite. You saw 25% upside to our target price for Microsoft. Let's look at valuation methodology number 3, and then we'll take an average of all 3, okay? I don't like this next one, but it's important for me to show it to you. Okay. DCF. DCF stands for discounted cash flow. And a lot of people like to use DCF because the value of a company today is basically the value of all the future cash flows of this company, longer term. I'm not a fan. It's not an exact science, but we're going to do it anyway. And let me just tell you why I'm not a huge fan right now. DCF has many more steps, right? It becomes much more complicated. And if I told you that x plus 1 equals 3, then x equals 2. If I told you that x plus 1 plus q plus w plus a plus b plus j plus t equals 3, what is x? Exactly. We don't know. There's too many independent variables with discounted cash flow, okay? So too many independent variables. So much can go wrong with it. But we're going to do it anyway because I think it's important for you to understand how to discount cash until today. And we kind of did this when we looked at the valuation that Sequoia wanted. Remember earlier on, Sequoia wanted 50% return every year over 5 years. And so we took a $10 million valuation for Giancarlo's POS company, point of sale company. So that $10 million valuation discounted by 50% per year over 5 years, got to a valuation of, I think, $1.3 million, something like that. And what we did was we divided the $10 million valuation divided by 1 plus 50% to the power of the number of years we were discounting it. That's basically DCF. All right, I'm going to make DCF relatively easy for you. Okay, so earnings and cash flow are the same in the long run. Okay, good. Great. So we don't need to forecast our balance sheet or the cash flow statements. Okay, great. Awesome. So here we go. There's our income statement. And you see the red little rectangle there? That's around net income. And I did that because that's our cash flow estimate. Okay, net income and cash flow is the same thing over time. Okay, over time. All right, great. So let's come up with the WACC. What's the WACC again? That's the weighted average cost of capital, which basically means what's the interest rate we're going to use to discount those cash flows in the future to today. Okay, remember, money in the future is worth less than money today. So if I gave you 10 bucks 10 years from now, right, that 10 bucks is worth less today. Okay, all right. So the WACC, weighted average cost of capital, equals how much you're going to pay for equity, I mean, what's your interest rate or your cost of debt. And because this is a tech company with no debt or very little net debt, just bear with me, we don't care about debt. Okay, so the cost of equity, we covered this before, is equal to the risk-free rate, meaning basically the government interest rate, plus a way to make it a higher percent because Microsoft has more risk than the government. Okay, and the same can be said for all investments. So again, the cost of equity, for Microsoft is the government rate or the risk-free rate plus the stock market return minus the risk-free rate times the beta, meaning how volatile is the company going to be relative to the market over time. And so beta is a measure of volatility, meaning how much a stock moves relative to the rest of the stock market. And a very risky company, an early stage company, has a very high beta, right? Like a beta of 2. And that means that it has twice the volatility of the market. Okay, so in a bull market, when stocks are doing great, that risky company goes up twice as much as the market because it has a beta of 2. But when the market is down, we're in a bear market or the economy's not doing well, then that company's going to go down a lot more because it's got a higher beta in the market. The market's got a beta of 1 on average. So what's our beta of Microsoft? Do you think it's above 1 or below 1, and why? Microsoft is a big, mature company. Very little risk compared to other technology investments. Okay, so the beta on Microsoft intuitively would be less than 1. So how do we figure out what the beta is of Microsoft? Do we have to calculate it? Heck no. We're going to find it on the internet. Okay, we'll find it in a second. So the average stock market return over time is, let's just say 12%. Okay, and let's say the government interest rate or risk-free rate is 1%. So that means that the cost of equity is going to be 1 plus 11% times how volatile Microsoft is. Okay, so here we go. What is our beta? We don't have to calculate it. You just find it on the internet, right? So if we go to Yahoo Finance, we can find out that Microsoft's beta is 0.78, and that makes sense to me. Why does that make sense to me? It makes sense to me because Microsoft is a big cash-rich machine or whatever that's mature and not growing much, yada, yada. So it's lower risk, okay? Lower risk. And so more risky companies have a beta of 1, above 1, and less risky companies have a beta below 1, okay? And I used to get all this information from Bloomberg, and I would pay literally 25 grand a year to get access to this information. It's a waste of money though, because you, the investor, and me, the individual investor, have the same access that everyone else has on the open internet, okay? Google Finance is great. Yahoo Finance is awesome for press releases. You can get most stuff that the pros can get for nothing, Okay, so our cost of equity is now 1 plus 11% times 0.7.